Hi, Greg Dorsey here. It's Monday, January 10th at Leeb.com, Leeb.com. Well, Alcoa kicked off the fourth quarter earnings season today, and so far we have to call it a yawner. The company beat on the bottom line, earning 21 cents a share versus expectations of 19 cents. It also came in light on revenues, however. The stock was essentially unchanged in after-hours trading. To be fair, the stock had run up nicely in recent weeks, so the absence of a decent correction should be taken as a victory. In the coming weeks, we'll be treated to a slew of profit reports. The consensus among analysts is for a 30% rise in profits among S&P 500 companies on the back of a 7% rise in revenues. Those are pretty high expectations on the earnings front. And while in recent quarters the trend has been for modest positive surprises, with stocks trading at 15 times expected year-ahead profits and more than 10% above their 200-day moving average, the likelihood of a sharp run-up in the averages in the next few weeks would appear to be quite remote. A 5 to 7% correction, on the other hand, if Wall Street's expectations aren't exceeded, wouldn't be the least bit surprising. The most likely culprit for such correction would be additional gains in commodities. Not that the market needs an obvious trigger for declines of less than 10%. And speaking of commodities, this morning we got a very small taste of what life in a post-peak oil world will look like. The Trans-Alaska Pipeline, which ships about an eighth of U.S. crude oil production, was shuttered for the third consecutive day due to a leak at the northern end of the pipeline. The shutdown has yet to affect shipments from the Port of Valdez, but the potential consequences of a continued idle pipeline were enough to send oil prices up 1.5% today. So we'll be watching this closely. That's all for now. Thanks for stopping by. We'll see you again soon.